Today, I want to break down how AI will impact C&D properties. These are specified classes of properties and neighborhoods that we normally have been safe to shop in, and what savvy investors like us should be doing right now to stay ahead of the curve.
So I convinced my partners for our real estate private equity fund, Invictus Elite Capital Group, to make content for y'all because they are so smart. So enjoy.
I'm sure you've read or heard about it by now, but by 2030, 90% of jobs could be replaced by AI. Sounds wild, right? While the 90% figure is likely exaggerated, let's not ignore the ripple effect that has on something we all care about, housing. I'm Noel Parnell, real estate investor and educator. So C&D class properties are often home to blue-collar workers, warehouse employees, call center reps, truck drivers, retail clerks. But here's the problem. These are the same exact jobs being targeted by automation and AI. When these jobs vanish, rent stops flowing, evictions go up. Maintenance gets deferred, and your cash flowing building, guess what? Now it's become just a simple liability. C&D class properties have long been a favorite for cash flow investors, but we're entering a new era, and the old way of doing things just won't cut it anymore. So here's the hard truth. We really have to adjust. We have to make strategic maneuvers and methodologies. Because tenants in these buildings, the warehouse workers, the retail clerks, the call center reps, the truck drivers, are first in line to be replaced by AI and automation. Self-checkout kiosks, delivery drones, AI-powered customer service. This isn't theoretical. It's already happening. So how does this impact us as owners? First, rent becomes fragile. C&D tenants often live paycheck to paycheck, not because they want to, it's just because of what the pay gives them and their, the environment that they're given. If AI wipes out their job, rent stops. No notice, no buffer. Now you're chasing rent, filing evictions, and watching your net operating income evaporate. Turnover explodes. Job loss leads to early move-outs and skip leases. Now you're dealing with vacancies, placement calls, inconsistent income. Now, the next thing, I've already been seeing this happening. Deferred maintenance becomes the norm. Less rent means less upkeep. Issues get ignored and turn into big ticket repairs. The property declines, refi options shrink. Your tenant base shifts really fast because no jobs equals no stability. Neighborhoods with strong job anchors risk becoming economic dead zones. Let me repeat that. Neighborhoods without strong job anchors risk becoming economic dead zones. Repeat that to yourself. Because your tenant pool shifts from working families to high-risk applicants. And that's if your housing subsidies still exist. So what do we do? All right, let's talk about how do we protect our investments. One of the main things I want everyone to stop doing, well, not to stop doing, but we have to be aware, but stop buying based on cash flow alone. Go deeper. Ask, what is the job mix in this zip code? Are there hospitals nearby? Trade schools? Logistic hubs? Data centers? If the local economy can't adapt to AI, neither can your tenants, and neither will your building. You need to underwrite for disruption. You heard me mention earlier about the underwriting. It's going to be really important. Use conservative assumptions. 15% vacancy, higher turnover, slower rent growth. And build in larger CapEx reserves because deferred maintenance is coming. You can also, and I think this is wise, treat C&D as short-term plays. Think 3 to 5 year holds. Force the appreciation, stabilize it, and exit before the local economy shifts. Don't marry these deals thinking they're going to pay you forever. They probably won't, and most likely they won't. So you're like, oh, damn, this has been my bread and butter. All right, listen, you don't need to panic, but you do need to pivot. So how do we pivot? All right, focus on B-class properties in growing areas. These attract tenants in healthcare, logistics, education, and skilled trades. Jobs that are really AI resistant or AI augmented. Avoid D-class altogether. Unless you're doing some mission-driven investing with subsidies, and support system is in place. But even then, these areas could easily become an economic ghost town if we're not careful. C-Class, listen, C-Class has been my bread and butter for over the last 10 years, but be highly selective. Only buy where there's redevelopment pressure, hospital expansion, major infrastructure projects in progress. Here's the bottom line. AI is coming for the workforce, and that means it's coming for housing next. If you're still investing like it's 2015, you're going to get crushed in 2030. But if you shift your strategy, follow the economic drivers, and build value beyond rent, you won't just survive, you'll lead. If you're looking for help navigating this next wave, it's here. Reach out.
And by reach out, he means join our newsletter. This is how the 1% get rich without getting screwed. It's a daily-ish newsletter where we share our business frameworks and our research that we use to build our fund, and we share it with you for free. It is chock full of game. This is where the smart people get smart while everybody else scrolls Instagram. Go down the link below and join and add yourself. It's absolutely free, and we just share all the game. Enjoy.